Welcome back, YouTube. In this video, we are going to talk about SOFI's recent reporting that has caused the stock to absolutely skyrocket. We're going to go over Microsoft. What is a fair value for Microsoft? What would I pay in this market and with the recent earnings report? And lastly, is FANG dead? So as we can see here, when we go over to tip ranks, Microsoft is definitely a loved stock with a price target of $212 all the way up to $315, 16 buys, 3 holds, and only 1 sell. As most of you probably already know, Microsoft holds a pretty substantial weight in the S&P 500, roughly 5.6%. And we've talked about the overweight of the FANG stocks in the S&P 500 and how they are trading for above average multiples, but the growth rates have slowed drastically over the recent years, meaning that the underperformance in FANG is probably going to stay here for a little longer. A lot of FANG stocks had trillion-dollar market caps, and now their growth rates are starting to slow, which is why I've been saying an equal weighted S&P 500 probably makes more sense than going overweight in the FANGs, as we're starting to see energy, utilities, and consumer staples really outperform over the last 18 to 24 months. And if you haven't had exposure to those stocks, your portfolio is probably flat to down. When we look at Microsoft's business from a whole, definitely more than just a technology company, which makes owning this company pretty valuable as there's many strong companies within this one monster company, making it a well-diversified stock to own. We have everything from LinkedIn to Azure to Windows to Xbox content, and even devices. But when we take a look at year-over-year growth with a lot of their sectors, we can see that devices took a major hit. Now, we've talked about this with Intel and a lot of the computing that took place. Demand was pulled forward throughout the pandemic, and now we're starting to see that everybody has new products, and right now they don't need to upgrade, and we're starting to see that even within Microsoft. I think the same thing can be said for Windows OEM. And in my opinion, Azure really saved the day along with Microsoft Cloud revenue coming in at 38 and 29% growth rates year over year, respectively. Now, when we go over to stock analysis, we get a $236 price target all the way up to $431. And when we take a look at what their projected growth rates are, we can see here they're projected to grow 9%, 13%, 14%, and basically maintain double-digit growth rates. Now, the problem I have with this is in Microsoft's earnings, we can see here intense competition in all markets that may lead to lower revenue and operating margins. So we can see here that even Microsoft's forward-looking statement is getting concerned that margins can be impacted here and lower revenue going forward. When we look at what their revenue was, the revenue only came in at 2%. So we can see here that analyst expectations could be pretty significantly off here. 8% lower, and net income came in 12% lower. When we bring that into a earnings per share basis, down 11%. So we're starting to see some fluctuations here. Revenue, yes, slightly up, but when we look at operating margins coming down, earnings per share coming down. One thing I also want to point out with Microsoft is cash and cash equivalents are coming down, and that has been a trending factor over the last couple of years. Obviously, this is a Class A balance sheet, not much to worry about, but just something to keep an eye on. We look at net cash from operations. We can see here that after it paid its dividend, it did exceed net cash from operations. And when we look a year ago, it was a little healthier, coming in at $14.4 billion and paying out nearly $12 billion. Obviously, with the amount of cash on this balance sheet, it is not even a concern, but just something once again to keep an eye on, as the business is definitely in kind of a transition period here. So the picture I'm going to paint here is that revenue is probably going to only increase around 3 to 4% going forward, just to err on the safe side. So I'm going to use 3% from years 1 through 3. I think interest rates will eventually come down, and I think that'll also help. In the years from 6 through 10, I'll have them growing 5%. As we can see here, EBITDA margins usually push over 40% on Microsoft, but what I'm going to do is just err on caution and say over the next few years, they're down to about 44%. In years 3 through 6, we'll do 45%, and years 6 through 10, 46%. So for a rate of return, I'm going to use 11%, and that'll, with the dividend reinvested, that'll get me a little over 12% rate of return. When we look at EV to EBITDA, it definitely trades for a substantial premium to its peers at a 18.6 versus nearly a 14 for industry standard. Before we give a price target, there's a couple things I want to talk about in valuations contracting here. The biggest problem we're going to have is figuring out a true multiple to put on a company like Microsoft. As we can see here, in 2021, they were trading as high as a 92.5 EV to EBITDA. And when we go to where they're trading now, coming down to 18.2 EV to EBITDA, this is massive, massive contraction taking place, going from a $2.5 trillion market cap down to a $1.85 trillion market cap. Trailing PE and forward PE once again coming down drastically. And in my opinion, this has a lot to do with obviously the economy slowing down, but along with that is interest rates now on the rise. I think we can, if we're projecting out further and we think the Feds are going to possibly cut rates, I think we can put a little bit of a higher multiplier on. So with where they're at right now, if we use an 18 multiplier, we get a $148 price target with a fair market of $380 a share in 2031. That gives it roughly a $2.5 trillion market cap in 2030, which is about where it was a few years ago. And when we think about the dot-com bust, very similar situation where valuations reached extreme levels and companies never really reached those levels ever again. And some did, but it took 10, 11, or even 12 years to get to those valuations. Could this be a similar scenario? Yeah, I wouldn't put it by the fact that this could happen, but I would say let's put a 25 multiplier on Microsoft, as historically it has traded much higher than where it is today from an EV to EBITDA multiplier. But I'm also going to go over one more thing here. We get a $204 price target on Microsoft, which gives me about a $175 to $180 price target for Microsoft. This is just me personally, guys, but what I want to show you here is one more thing. Let's take a look at where earnings came in. Earnings came in down from a year ago to $2.20 per share of earnings. Now, if you believe the economy is in a slowdown, and this is what we can expect over the next couple quarters of Microsoft, if we annualize this out, that does come out to be around $8.80 per share. And if we put a 20 multiplier on that, which is about what a market multiple is right now, that gives us $176 a share. We put a 22 multiplier on that, that gets us to $193 a share. So I think this makes a lot of sense. Between $180 to $190 for Microsoft makes a lot of sense. Now, I've had a price target on SoFi for under the $5 mark. $4.79 is roughly where I thought SoFi got fairly interesting here. And it's been trading as low as $4.25 up to $5 for an extended period of time. So you would have had an opportunity to accumulate well below $5 a share. So what's causing this to absolutely skyrocket? Record fourth quarter adjusted EBITDA of $70 million, up 15 times year over year, 58% sequentially. Fourth quarter, $40 million GAAP net loss, which improved 64%. They are on the verge of free cash flow. As we all know, EBITDA is a proxy of free cash flow. So product lines are growing, they're getting close to free cash flow, and from a per share basis, they went from negative 15 cents a share down to negative 5 cents a share. Still growing strong members and products, and with rates on the rise, definitely impacting SoFi's financials. EBITDA went from $4.5 million to now $70 million for the quarter, up 58%, and that's where I think we're starting to see why the stock is skyrocketing. People do not want to deal with companies hemorrhaging money, and as we can see here, SoFi is on the verge of going positive. And when we come down here, it says full year management expects adjusted net revenue of 1.9 to 2 billion, up 25 to 30%, and full year adjusted EBITDA to 260 to 280 million. So let's plug that in and see what we get for a price target. And when we look at a multiple to put on SoFi, industry standard is going to be sitting around 12 to 12.5. So I'm actually going to plug that in as well. I have it at 10, so we're going to see a substantial rise here. And now with a multiple of 12, we get a $6.27 price target. We could even put a 13 multiplier in there as it was a high 12. So $6.50 seems to be a fair price target for SoFi, which gives it a 2030 price target of $15 and an enterprise value at that point in time of nearly $21 billion. 82 cents now. I think we're going to see a possible pullback. This was a heavily shorted stock, and a lot of people are on this stock, both short and long. A lot of big swings within this company, as we see, was up 17 to 20% earlier, and now it's starting to cool off a little bit. This definitely becomes a very interesting stock below that $5 mark again. If we see that below $5, I think you can buy SoFi with some confidence here, knowing that they are on the verge of doing some big things here, getting free cash flow in the right direction. They're obviously still growing substantially, so you want to see them maintain those growth rates. You want to see them maintain on the process of free cash flow. So interesting stuff. Now, I want people to understand this does trade for a hefty premium. This is a company that is unprofitable still, even though they're on the verge of profitability, and they're getting over a $5 billion market cap. So I wouldn't say you're getting a tremendous deal buying it on a day like today, but I would say if it gets back below $5 and $6, you have to look at this one, guys. Now, really quick, I want to touch on FANG, as I believe FANG is starting to reach a growth rate that is starting to slow. We're starting to see companies like Apple, Google, Microsoft especially, even Facebook with the recent drawdown. Their business models are mature. They're not going to have the substantial growth rates that they've had over the last 10 years. Going from doing 300 or 400 billion in revenue to doing a $500 million, it takes a lot of energy to get that trajectory up. So the growth rates tend to slow as these companies are now juggernauts. They have many businesses within their models. They're starting to reach a maturing point here where it's really, really hard for them to grow any more than they're growing. So that begs the question of, is FANG dead? And from a safety standpoint, I think, buying at the right price is always going to be the best option. You always want to buy good quality companies at the right prices. But I just don't think we're going to see those returns continue over the next 10 to 15 years. I don't necessarily think from a growth rate and a stock price standpoint, we're going to see companies like Apple, Google, Microsoft outperform some of the underlying stocks that are in the S&P 500 that don't get a tremendous amount of recognition or love. In some areas I can think of is definitely going to be companies that are in cybersecurity, could definitely be some of the chip makers. I tend to think that they've sold off so much and that they're probably going to sell off even more. There's going to be a tremendous growth rate opportunity for these companies going in the future. Now, this is just my opinion, and I tend to think those type of companies could outperform your bigger old school FANG stocks. As always, guys, appreciate your time. Thanks for tuning in, and we will see you in the next one. Peace.